Alright guys, we are from group 2. It consists of Priskawati, Takudin Amri and Tessa Laurencia. And we will discuss about chapter 10 in the section 1, that is credit analysis. So the table of content, that is the liquidity and working capital, the operating activity analysis of liquidity, and then the additional liquidity measure. The first one, that is liquidity and working capital, will be explained by me. That is, what is liquidity? So liquidity is the ability to convert asset into cash or to obtain cash to meet short-term obligation. The short term is the conventionally viewed as a period up to 1 year, so it is identified with the normal operating cycle of a company. The importance of liquidity is best seen by considering repercussions stemming from a company's inability to meet the short-term obligation. Liquidity is a matter of degree, so lack of liquidity prevents a company from taking advantage of favorable discount or profitable opportunities. And for a company shareholders, a lack of liquidity can foretell a loss of owner control or loss of capital investment. When a company's owner possesses unlimited liability, lack of liquidity endangers their personal assets. And then this scenario will highlight why measures of liquidity are of great importance in our analysis of a company. Then there are working capital, that is defined as the excess of current asset over current liabilities. And working capital is a widely used measure of liquidity. It is important as a measure of liquid asset that provide a safety cushion to the creditors. It is also important in measuring the liquid reserve available to meet the contingencies and the uncertainties surrounding a company's balance of cash inflow and outflow. Next will be the current assets and liabilities. So the current asset, there is the cash and other asset reasonably expected to be realized in cash or sold or consumed within 1 year. And then the current liabilities is the obligation expected to be satisfied within a relatively short period of time, usually 1 year. Next is the analysis must assess whether a current obligation with a reasonably high probability of eventual payment and reported in current liabilities. The three common concerns are the contingent liability associated with loan guarantees, the future minimum rental payment under non-cancelable operating lease agreement, and the contracts for construction or acquisition of long-term asset often call for substantial progress payment. And then working capital measure of liquidity. The loan agreement and bond indentures often contain stipulation for maintenance of minimum working capital level. And the financial analysis assess the magnitude of working capital for investment decision and recommendation. Also, the amount of working capital is more relevant to users' decision when related to other key financial variables like sales or total assets. Then the current ratio measurement liquidity is the relevance of the current ratio. Briefly, reason for the current ratio's widespread use of as a measure of liquidity include its ability to measure the current liability coverage, the buffer against losses, and the reserve of liquid fund. And then the limitation of the current ratio, that is the primary disadvantage of the current ratio, that is the ratio is not a sufficient indicator of the company's liquidity. The other limitation of the current ratio is the inclusion of the inventory in the calculation of the current asset. And then the formula is the current ratio equal to current asset per current liabilities. That is, the numerator of the current ratio will be cash and cash equivalent, marketable securities, account receivable, inventories, and prepaid expense, while the denominator of the current ratio is the current liabilities that are the focus of the current ratio. There is short-term debt, account payable, accrued liabilities like dividend, income tax, and payroll. And then we using the current ratio for analysis, we have the three conclusions. That is, the first is liquidity depends to a large extent on prospective cash flow and to a lesser extent on the level of cash and cash equivalent. Second is no direct relation exists between balance of working capital account and likely pattern of future cash flow. And the third is managerial policies regarding receivable and inventories are directed primarily at efficient and profitable asset utilization and secondarily at liquidity. Then there are comparative analysis. That is analyzing the trend in the current ratio that is often enlightening. The change in the current ratio over time must be interpreted with caution because the change in this ratio do not necessarily imply change in liquidity or operating performance. There are also the net short cycle analysis. That is the net short cycle. That is show how long the cash is tied up in the short cycle before coming back out as cash again. The longer the net short cycle, the larger is the working capital requirement, and then a company's working capital requirement are affected by its desired inventory investment and the relation between the credit terms from supplier and those extended to customer. This consideration determine a company net short cycle. And then the last is the cash-based ratio measure of liquidity. That is, there are cash to current asset ratio and cash to current liabilities ratio. So the cash to current asset ratio is the ratio of near cash asset to the total of current asset is one measure of the degree of current asset liquidity. The formula is cash plus cash equivalent plus marketable securities per current asset. While the cash to current liabilities ratio is the ratio that measure the cash available to pay current obligation. That is cash plus cash equivalent plus marketable securities for current liabilities. Alright, for the next topic, operating activity analysis of liquidity will be explained by my friends.
Hello everyone, I'm going to explain about operating activity analysis of liquidity. Operating activity measures of liquidity are important in credit analysis. There are three operating activity measures. The first one is account receivable, and then inventory, and third one is current liabilities. The first measure is account receivable liquidity measure. For most companies, selling on credit account and not receivable are an important part of working capital. In assessing the liquidity, including the quality of working capital and the current ratio, it's necessary to measure the quality and liquidity of receivable. Quality refers to the likelihood of collection without loss. Their turnover rate is an indicator of the age of receivable. Meanwhile, liquidity refers to the speed in converting account receivable to cash. The receivable turnover rate is a measure of this speed. Right now, I'm going to show you how to calculate the account receivable turnover. The formula is as below. Account receivable turnover ratio equal to net sales on credit divided by the average account receivable. The receivable turnover ratio indicates on average receivables are received and collected during the year. Here you can see the example. Assume that consumer electronic report sales of $1,200,000 and beginning receivable of $150,000 and year-end receivable of $250,000. Its account receivable turnover ratio is computed as below, and we got the result 6. Days sales in receivable. The days sales in receivable measure the number of days it takes on average to collect account receivable based on the year-end balance in account receivable. It is computed by dividing account receivable by average daily sales. As follow, you can see the formula below. And for example, assume that consumer electronic report sales of $1,200,000, beginning receivable of $150,000, year-end receivable of $250,000, and we put this number into the formula, we will get the result is 75 days. Okay, let's move on to the next slide. Interpretation of receivable liquidity measure. Account receivable turnover ratio rates and collection periods are usefully compared with industry average or with the credit term given by the company. When the collection period is compared with the term of sale allowed by the company, we can assess the extent of customer paying on time. For example, if usual credit term of sale are 40 days, then an average collection period of 70 days reflects one or more of the following condition. First, poor collection effort. Second, delays in customer payment. Three, customer in financial distress. The first condition demand corrective managerial action, while the other two reflect on both the quality and liquidity of account receivable and demand judicious managerial action. Now we are going to discuss about the second measure. It is inventory turnover measure. Inventory are investment made for purposes of obtaining return through sales to customer. In most companies, a certain level of inventory must be kept. If inventory is inadequate, it will cause a problem, but if inventory is too much, it will also cause a problem. Due to the risks in holding inventories, they are normally considered the least liquid current asset. Our evaluation of short-term liquidity and working capital, which involves inventories, must include an evaluation of the quality and liquidity of inventory. Measures of inventory turnover are excellent tool for this analysis. Let's see about the inventory turnover formula. The formula is computed as cost of goods sold divided by average inventory. This inventory turnover ratio measures the average rate of speed at which inventory moves through and out of the company. And then there is days sales in inventory. The formula is inventory multiplied by 360 divided by cost of goods sold. There is another measure of inventory turnover useful in assessing a company purchasing and production policy. It is the number of days sales in inventory. This ratio tells us the number of days required to sell ending inventory, assuming a given rate of sale. Here you can see the illustration. It is the company for year 8 is reproduced below. Sales 1,800,000 and cost of goods sold 100 to 1,200,000. Beginning inventory $200,000 and ending inventory is $400,000. Then we calculate the days sales in inventory. It is $400,000 divided by 1,200,000 divided to 360, and then we get the result. It is 120 days. Interpreting inventory turnover. Inventory turnover ratio over measure of both the quality and liquidity of the inventory component of current asset. Quality of inventory refers to a company's ability to use and dispose of inventory. We also must be aware of inventory management because the effective inventory management could increase the inventory turnover. Quality of inventory refers to a company's ability to use and dispose of inventory. And there is another useful inventory liquidity measure. It is conversion period or operating cycle. This measure combines the collection period of receivable with the days to sell inventories to obtain the time interval to convert inventory to cash. You can see the illustration below. We will compute the conversion period. For example, days sales in receivable is 75 and days sales in inventory is 120, and then the total conversion period is 195. This implies it takes 195 days for a company to both sell its inventory and to collect the receivable based on current level of receivable and inventories. Liquidity of current liabilities. Current liabilities are important in computing both working capital and the current ratio for two related reasons. First, current liabilities are used in determining whether the excess of current asset over current liabilities afford a sufficient margin of safety. Second, current liabilities are deducted from current assets in arriving at working capital. The quality of current liabilities is important in analysis of working capital and the current ratio. Not all current liabilities represent equally urgent or forceful payment demands. The quality of current liability must be judged on their degree of urgency in payment. Days purchases in accounts payable, a measure of the extent to which company lean on the trade is the average payable days outstanding. This measure is computed as below. Average payable days outstanding equal to account payable divided by cost of goods sold divided by 360. First, we will calculate the COGS divided by 360, and then we will divide it to the accounts payable. The average payable days outstanding provide an indication of the average time the company takes in paying its obligation to supplier. The longer the payment period, the greater the use of supplier capital. A related measure is account payable turnover. It is computed as cost of goods sold divided by average account payable. This ratio indicates the speed at which a company pays for purchases on account. That's all my explanation. The next material will be presented by Rizkawati.
Okay, now we move on to the next topic. It's about addition liquidity measures. So in addition liquidity measures, there are 6 points that we'll discuss in here. The first is current asset composition. Second is asset tax quick ratio. Third is cash flow measures. Fourth is financial flexibility. Fifth is financial management discussion and analysis, and the last is what if analysis. Now we'll discuss one by one. Okay, current asset compositions. So the current asset compositions is an indicator of working capital liquidity. The use of common size percentage comparison facilitates the evaluation of comparative liquidity. You can see in the slide, this is the example of Texas Electricity current assets along with their common size percentage are produced in the below for the year 1 and year 2. Look into the account for cash, account receivable, and inventories for year 1 and year 2. And if you check deeply, you will see that cash and account receivable in year 1 is higher than in the year 2. What does it mean? It means that an analysis of Texas Electricity common size percentage reveals a marked deterioration in current asset liquidity in year 2 relative to year 1. This is evidenced by a 10 decline for both cash and account receivable, like what I said before. Move on to the next slide. Asset tax quick ratio. So the ratio includes those assets most quickly convertible to cash, such as stringent test of liquidity and computed as this is the formula: cash plus cash equivalent less marketable securities plus account receivable minus current assets. And if you look into that formula, there is no inventories over there. Why? It is because inventories are often the least liquid of current assets and are not included in the asset tax ratio. And the reason is because their evaluation typically involves more managerial discretion than requires for the other current assets. Move on to the next slide. Topic about cash flow measures. And for this is the next for dynamic measure of liquidity. Afterward, knowing the current ratio and its inability in recognizing the importance of cash flow in meeting measuring obligation. The formula itself is operating cash flow divided by current liabilities. Next, financial flexibility. Financial flexibility is the ability of a company to take steps to counter unexpected interruption in the cash flow of funds. There are 4 factors bearing on us assessment of a company's financial flexibility. The first is rating of its commercial paper, bonds, and paper stock. Second is any restriction on its sale of assets. The third is the extent expenses are discretionary. And then the last is the ability to respond quickly to changing conditions, such as strike, demand shifts, and breaks in supply source. Move on. Now is the management discussion and analysis. The Security we know and Exchange Commission requires companies to include in their annual reports an expanded management's discussion and analysis of financial condition and result of operation, MD&A. The financial conditions section requires a discussion of liquidity, including known trends, demands, commitments, or uncertainties likely to impact the company's ability to generate adequate cash. And if a material deficiency in liquidity is identified, management must discuss the course of action it has taken or proposes to attack additionally the deficiency. And internal and external sources of liquidity and any material unused source of liquidity must be identified and described. Next, this is the last analysis, what if analysis, like the name, what if it happened. And what if analysis is useful technique used to trace the effect of changing in condition or policies on a company's resources. Look into the data. This is the year one. Wait. This is the year one. You can see common account, cash, account receivable, inventories, fixed asset, accumulated depreciation, account payable, not payable, securities liability, and capital stock. And the following additional information reported for the year ended December 31. In year one, cost of sales, par cost, depreciation, and net income. For the number itself, you can see on the slide. Consolidated Technologies anticipated a 10% growth in sales for year two. All revenue and expenses items are expected to increase by 10% except a depreciation, which remains the same. All expenses are paid in cash as they are incurred, and year two ending inventory is projected at $150,000. And by the end of year two, Consolidated Technique is expected to have not payable of $50,000 and zero balance in accrued taxes. The company maintains a minimum cash balance of $50,000 as managerial policies. Now we look into the answers. This is the Consolidated Technique use data. You can see actually this is all based on the data. For the number itself, like the information before all the expenses and sales is expected have 10% increase, and all the numbers C in noted A, B, C, and yes, that's all. You will find how that number comes from this slide. This is why 1 by 1 means 110% divided in 100, and you can find this number. And all this formula actually we already known in our material previous semester, as usual, as knowledge as accounting students. Okay, maybe that's all from me and from our group. Thank you for your attention, and if you have any question, you will directly ask in our class. Okay, see you and thank you.